There are two times when there are easy trades of the day, for me at least. The easiest, most of them are in the first hour. There are usually 3 or 4 trades in the first hour that are fairly easy, at least for scalps. And I say this all the time. Anytime there is a potential reversal, and the body of the bar is not a doji, you can usually trade it for at least a scalp. So, for example, here's a reversal from the moving average with a bear bar. That's a reasonable short. Here's a reversal up to a possible higher low with a bull bar. That's a reasonable long. This has a strong up move. I think it's bad to be looking to short, and certainly with that as the entry bar for the low 2, low 1, low 2, so I wouldn't short that. Buying this as possible first pause in a trend from the open bull, that is okay. Selling this, I've already explained why I didn't short that, but I think that was a good short if you had patience to sit through the pullback. This low 2, I think I mentioned it when the market had already ticked down 2 or 3 ticks, and I didn't take it, so I ended up having to chase it. But I thought that was a good short. Shorting below this bar, I just made a mistake in not doing it. I don't know what I was doing at the time, but I remember looking over here quickly, and I was a tick or two too late. So I was probably looking at stocks or something. But as I said, you have a couple ticks below here. You have 1 tick below here. If the market gets below here, there's a pretty good chance it's going to come down and try a breakout test. That was one of those instances when just shorting the breakout would have made really good sense. Once I saw it, I decided I got to get in, and I started looking for 2 or 3 tick pullbacks to short. As I said, you could also look for low ones on the 2-minute chart or 3-minute chart or 1-minute chart. And if you did the 2-minute chart, you would have had 1, 2, 3, 4, 5, shots at low ones. Beyond that, once the market is down here, either going to be a spike or it's going to be a trading range with 2 trend bars down and a reversal up. That's not a reversal bar. It was kind of tricky in here. I mentioned that below the micro wedge there would be buyers, and there were for a scalp, and the market had 1 low, 1, 2. I think these were difficult trades. This is okay, but not ideal because of the channel. I tend to wait for more information. At this point, I thought there was a very good chance of a higher low. So, I went down to a smaller time frame chart and bought down here. But that doesn't help anyone in the room. Looking back, I should have bought this. It was clearly a spike in a channel at this point. It clearly fulfilled the measured move, and I just made a mistake. I screwed up. I should have bought that, and I should have held through a pullback for 2 legs up, so I could have made at least 2 points on it. And that was just a mistake on my part. I think this is a reasonable short. It had a lot of things going for it. The 2 things against it were the channel and my belief that the start of the up move was here, and the market would likely form a higher low and try to go up again. But for a scalp, at least, I think all the reasons I gave, I think that was a good scalp. Let me try to talk a little bit in terms of management. I shorted this, and my original stop was above this high, and the market went down and hit my limit order. I think I mentioned that I was only scalping, and I only scalped that. And I think I'm almost certain I only scalped that, and that was a mistake because this is a possible higher low and a possible breakout to a measured move up. I made a mistake scalping this. Anyway, the entry's above that bar. Original stop is below the bar. Once you have a bull close like this, I'm going to try to scalp part and swing part if I'm doing what I'm supposed to be doing. My swing, it's up, you're positive 3 ticks here. I would put my scalp stop below this bar because this is a pretty good attempt to go up, and I wouldn't want it to come down at this point. So my scalp stop is below here. My swing stop is still down here. And then at this point, once the market has a strong up move, a breakout move, I'd be filled in my scalp, and my swing stop would then be below here. But I would probably get out before then. I'd want to see what happens if, with the breakout. Here, the market formed a thin area, possible measured move up. At this point, I would exit below here. I think the always in traders would be short here. Maybe not. They may stay long with a break-even stop down here. But after the market came down a couple ticks, and then here, I think the always-in traders would have their stop below this low, and smart traders, people smarter than me, would have gone short below that low. If a trader bought here, the initial stop is below the inside bar, and I think a trade like that has a very high probability of going up in 2 legs for at least 2 points. I think the stop on the scalp and the swing are below here. Once the market makes a bull move, I think the scalp stop is below here. I would keep the swing stop probably down here until the scalp was able to get out. Over here, the scalp is able to get out. I would move the swing stop to below here. I would get out with 2 points. I don't think I would try to hold for more than that because of the moving average. This short, if you take it, the stop initially is above its high. You have a decent bear bar down. So on the scalp portion, I think you move the stop to above this high. You might do that with the swing as well, or you could keep the swing stop above there. After a couple more bars, you're out on your scalp. I would move the swing stop to above this high, so now the risk is 3 ticks. And I just made a mistake. I bought this, and I should have held it. I just broke my my own rules, and sometimes I do that. So I ended up getting a 1-tick loss instead of a 2-point profit. So is this a bear channel? So it's a bear flag, but there's a larger bull flag. I don't know which is going to win. 60-minute chart, the market is right below the moving average. The market has been very resistant to falling below the moving average and staying below the 60-minute moving average. I think there's a pretty good chance the market's going to push up to a new high. Daily chart, it looks like it may be trying to top out here. I'm guessing with the end of the quarter and then Friday's report. I can't believe they're having a report on a day when the market is closed and on a 3-day weekend, but that's what they're doing. To me, it's just unbelievable. But we have to deal with it. The market may be trying to round out here. It looks like it is. It looks like it will try to pull back to the moving average. It may start filling the gaps on the downside. Weekly chart, another up close. If you take this last of the lower highs down to the low, you get a measured move up to around 1200. It's a little easier to see that it makes sense if you look at monthly chart. Daily chart, you have a thin area between this high and these lows, and that projects up to 1180. If you use this gap as a measuring gap, that's just about 1200. And if you use this weekly chart measurement from here to here, that's also at 1200. So I think the market has room to go up more, but I just don't know if it will. Okay, so come Monday, the market's trying to break out of this large channel to the upside, and I think that is the most likely influence going into the week. This may prove to be a bear flag, and it may break to the downside, but given how persistent the market has been in staying above the moving average on the 60-minute chart, the odds favor more up. Okay. Thank you all. I hope everybody has a good weekend.